And look, I've got 5 predictions for the rest of Trump's term. This is something I've been wanting to revisit because this started on April 8th, 2025. I had made 6 different calls then based on Trump's then plans. But a lot has changed since then. So let's see how those first 6 trends that I pointed out, let's see how those are doing. And then I've got 5 brand new ones for you. So with the original 6, my first one, the big pick was to bet heavy on the power behind AI, not the applications themselves. And last year alone, the nuclear index returned 55%. So check, got that one right. I also said the big trend would be in quantum computing. And those stocks have more than doubled since. So there's another one. And I said the middle class was gonna start getting wrecked and pushed into the discount stores. And today, affordability is all anybody on TV talks about and will likely be the deciding issue in the midterms. I think this could really wreck the Republicans if they don't start addressing the kitchen table topics like this and start addressing them soon. You know, I'm not sure if there's much that they can do in such a short time, but they've got to at least address it. Or I think they're toast come election night. Now, trend number 4, I said the factories are coming home. Today, that's official government policy. Production lines are running and finished products are leaving American factories, although nobody's covering it and telling you. I mean, this week alone, LG started production at a $2 billion Michigan battery plant with 900 people already working, while Volvo's first American-built excavators began reaching customers from Pennsylvania, all this week. And there were 2 other trends that I pointed out based on the aging population and major housing changes. Now, it's still too early to call those, but there is movement in the right direction for both. And if you want to watch that video with all of its details, I linked it down below in the description. But the point being, 4 out of 6 delivering sooner than we expected, with 2 still developing. Now, let's dive into 5 more predictions that I see for the rest of Trump's term. But you know, I'm just a US Marine who buys houses for a living. I've got no secret clearance, no insider information. I'm not even on some classified group chat. So how did I nail all of those with such accuracy? And why do I feel so confident about these next 5 that I'm about to share with you? Well, I've got a friend, Mike. He actually shared those 6 calls with me and gave me permission to share them with you last time. So I can't really take credit for them. They're Mike's calls, not mine. Mike is a billionaire, the only one that I know, private guy, no YouTube channel, no X account. He doesn't watch the market, he moves it. And he was in town last week and we had dinner again and we did some catching up. So of course, I took my notepad with me so I wouldn't forget anything to share with you. So here's what I wrote down and what I found when I spent this week checking his claims. Prediction number 1, the rescue isn't coming, at least not the one that we've all been waiting for. You see, for 2 years, the plan in half the neighborhoods in America has been the same. Hang on, rates are gonna come down, and then we can go out and buy a house, then we can refinance, then we can sell, then we can move, then we can finally breathe. But here's the deal. Washington is sitting on more than $40 trillion of debt. It actually crossed that line this week. And look, this week we got a preview of what that means. You see the interest rate on the government's 30-year debt, the rate that helps tug mortgage rates up or down, it hit its highest level since 2007. So Treasury Besant announced that it would begin buying back more of its own long-term debt. Now, to be clear, this is not the Fed printing money yet, sort of. And it doesn't make $1 of the debt disappear, that's for sure. But it's closer to Washington replacing some of its old IOUs with new ones. Treasury's official explanation is that this will help the bond market run more smoothly. All right, fine. In plain English, though, Washington wanted to calm the sell-off and take some pressure off those long-term rates. So it worked for about a day. The 30-year rate dropped, then it climbed right back to 5.25%, almost where it started. So why did that happen? Because even if the Treasury does several of these purchases, $4 billion at a time, is tiny next to the nearly $550 billion in new bonds the government expects to sell this quarter. The market looked at $4 billion and said, that's not enough. And the very next day, Treasury Secretary Besant said, they may go bigger. That matters to you because the average 30-year mortgage is still 6.72%. Refining is even worse at 6.88%. Washington pulled its first small lever. Mortgage relief still didn't show up. And now they're already talking about pulling a bigger one. You see, that's the whole machine warming up. And a good portion of the market is actually expecting the Federal Reserve to raise rates at its September meeting. The Fed chairman, Kevin Warsh, was Trump's own pick. And everybody in Washington knows why he got that job. He was expected to cut on command. But Put yourself in Warsh's shoes for a minute. The president who hired you just hit 33% approval, the lowest of this term. And the war's dragging on, and gas is up, and Warsh can read X like everybody else. He knows what it looks like if he cuts per orders from an unpopular president. He wears the puppet label going forward. He doesn't want that. And here's the detail that decides it. You see, Trump is on the clock. His term ends in a couple years. Warsh's term keeps running right past it, meaning Warsh will still be here when the president is gone. And he's thinking about that. He's thinking about his future reputation. And he's probably got a little bit of pride in there mixed in. He's going to stand firm longer than anybody expects, so he can walk around as his own man. See, the White House can't fire him either. The Supreme Court already blocked the attempt to remove one of the Fed's own governors back in June and used that ruling to underline the Fed's independence. So follow the chain. The inflate away play still comes. It has to, but it comes later. Inflation is going to be delayed. Mortgage rates stay where they are while Warsh protects his reputation. The homeowner sitting on a 3% loan still can't afford to move. Homes for sale stay scarce. Prices stay stuck. The market is going to be frozen, the housing market. And the person waiting for the rescue gets caught twice, paying today's rates now, and when relief finally arrives, it arrives dressed as inflation, shrinking every dollar they saved while they waited. Now, the pushback that I'll get here is now the Fed is just going to cut and save us, right? Well, here's the problem. The Fed sets the short rate. Your mortgage follows the long one, and the long one is rising because investors can smell the inflate-away plan coming. The more obvious the plan gets, the longer your wait. That's the likelihood. But the economy, the overall world, in fact, it's volatile right now. A lot can happen over the next several months, which makes it super tough to predict events. However, it's easy to predict people's actions, and people's actions typically spark new events. When we're talking about fear, self-preservation, politicians protecting their seats, institutions protecting themselves, money running from what it doesn't trust towards what it does. None of that has changed since the Romans. And that's how Mike makes his calls. He ignores the headlines. He bets on what people do under pressure. Then he checks his work against the only poll where lying costs money, where lying can be expensive. I'm talking about the betting markets. We didn't have that tool before a few years ago. That's new for us. And over $130 billion traded on real-world outcomes in the first half of this year, up from $50 billion in all of last year. It's here to stay. The parent company of the New York Stock Exchange just put $600 million into one of these platforms. People lie to pollsters, as we learned this week. People do not lie with their own money, which is exactly how he reads prediction number 2. The prices never come back down. This spring, oil spiked past $120 a barrel when the Strait of Hormuz got really ugly. Then we had the ceasefire, and prices didn't return, did they? They settled almost 40% higher than a year ago. And once traders price a risk into a barrel, they don't unprice it just because the headline moved on. They keep a floor under it. And look, even this week's news proves the point. CNN, of all sources, just reported that Iran is losing some of its control over the strait. More than 80% of the ships that made it through recently used the side that Iran told them not to use. So yes, Trump is right about one part. The ships are moving again. But before the war, about 130 ships crossed every day. Right now, it's more like 10 to 20. Now, some of those are giant tankers, so there is more oil getting through than that number makes it sound like. But regular shipping is still nowhere close to normal, and oil is still hovering around $90 a barrel as of this recording. And now Trump is moving the fight from bombs to bank accounts. His administration is warning that America may punish the countries and the companies that keep buying or doing business from Iran, not just Iran itself. So the waterway may be improving, but the fight didn't disappear. It's just changed forms. And the old price still hasn't come back. CoBank, a $139 billion bank that finances rural America, they just projected fertilizer prices stay elevated through 2028 because 45 million tons of fertilizer and raw materials squeeze through that same narrow strait every year. One waterway that we hadn't heard, none of us had heard of 6 months ago. It's all priced now into every bag of groceries over the next 2 years, at least. Tariffs, same thing. The average tariff went from about 2% to about 10% in a single year. The Supreme Court struck the main batch down in February, remember that? Well, within 6 months, they came back under 3 different laws. You probably don't remember that because they didn't mention it. Meaning, this stopped being a negotiating tactic. It's the floor now. Businesses already rewired their supply chains around it, and nobody rewires for free. They hand the bill down the line until it reaches the last person pushing the shopping cart, us. And sure, oil could tank by Christmas. Commodities, they do that. But by then, the spike has already crawled into freight, food, repairs, and insurance. Even if inflation falls back to 2%, that doesn't bring the old price tags back. It just means the new, higher prices climb slower. That's us. That's what we're dealing with. And we didn't cause one bit of it. We bought a house and we buy groceries. And that's the whole crime that we committed that we're going to be paying for in the foreseeable future. Now, here's where this prediction really lands, though. It's your insurance renewal. You see, the rebuild cost is the spot where tariffed lumber, scarce labor, and expensive energy all collide. And your insurance company doesn't price your house based on what Zillow says today. It prices what it would cost to rebuild your house next year. And when that number jumps, your premium chases it up. And if your coverage doesn't chase it too, you're quietly underinsured on the worst possible day. Now, with that said, you should be shopping your insurance at least once a year now. That's the only defense you really got against this. I put a link in the description down below to help you do that. Prediction number 3. Before this term ends, AI breaks one of two things, either the job market or your retirement account. I mean, the people building AI, they can't agree on what it becomes, but there's a fork that they do agree on. Either AI gets good enough to replace a big slice of human work, or it doesn't, and trillions of dollars in stock value are resting on a story that didn't come true. Now, there may be a third branch. AI could wipe out some jobs, then create completely different new ones. I mean, Robert Half found that almost 1 out of 3 hiring managers who cut positions after bringing in AI had to bring the same jobs or very similar jobs back. And LinkedIn says AI job postings have roughly doubled since 2023. Gartner now believes AI will create more jobs than it destroys beginning in 2028, before this presidential term ends. That sounds like nobody gets hurt, but the new job doesn't automatically go to the person who lost the old one. So maybe AI doesn't break the job market by making all the jobs disappear. Maybe it breaks the old map, millions of people trained for work that suddenly changes or no longer exists. The total number of jobs can rise, while millions of individual careers still get knocked sideways. Now, you might be thinking, I don't own any AI stocks. I don't care about AI. I'm safe. I'm away from this. I'm careful. I just have a couple index funds. I'm good. Well, odds are you're all in anyway without even knowing it. You see, 7 companies, Apple, Microsoft, Nvidia, and their friends, make up roughly a third of the entire S&P 500. Last year, those 7 stocks produced about 42% of the index's whole return. Meaning, if you own a standard S&P index fund, $1 out of every 3 at least is betting on AI. And this week, the Fed's own meeting minute said the quiet part out loud, as it typically does. Their measure of stock market risk has been lower only once in recent history, the dot-com bubble. And they warned an AI disappointment could trigger, their words, a significant repricing of stocks. So could AI just land soft, earnings catch up, nobody breaks? Maybe. But at prices the Fed itself compares to the dot-com era, the market has priced in perfection. And perfection, not a good plan. Now, here's the part of the AI story where everybody has it backwards, including the news, especially the news. The story that you've been fed is that the data centers are the villain here, jacking up your power bill, draining your water, wrecking the neighborhood. 2 out of 3 Americans believe that power bill part. So researchers at the Electric Power Research Institute, they went and checked. Did data centers raise residential electric rates? The answer was no. The average state's rates would be about 6% higher today without the data centers built since 2019. Because a customer that big helps carry the grid's fixed costs, the poles and wires you were going to be paying for anyway. And the water? This is a biggie. Every data center in America combined directly uses about 1/30 of what the country's golf courses use every year. And nobody's picketing golf courses. And you better not. And if saving water is really important to you, stop eating almonds. California's almond orchards alone use about 90 times more water than every data center in America combined. Not 9 times, 90 times. Did you learn something there? Because I sure did when I heard it. But you know what? I don't think it matters. The story's already out there. The damage is done. You can't unring that bell. Counties are voting these things down one after another over all of this bad information. And the part almost nobody is covering, the money stopped fighting the neighborhood and started recruiting it. Google's new Minnesota data center is putting $50 million into batteries hosted at businesses across that state, and the hosts are getting paid. Tesla and Sunrun just announced a program aiming to link millions of homes into what would be the largest power plant in America, made of America's homes. See, homeowners with a battery in the garage are already collecting a few $100s a year for letting the grid borrow that power at peak hours. Last summer, more than 100,000 homes in California powered half of San Francisco for 2 hours from their garages. Meaning, this build-out might not just bill the homeowner, it might pay the homeowner. Your house collecting a paycheck from the AI boom. Does it play out that way? I don't know. I mean, the data centers, they're coming either way. The real question is whether the grid grows fast enough to feed them all. If it does, they share the costs and your bill is minimally affected. If it doesn't, power gets tight and bills climb. But tight power is exactly why they're paying homeowners to host batteries in the garage. Either way, the homeowner likely comes out fine in the end. But nobody honest is pretending to see what happens past 2028 because AI is compressing the timeline. It's compressing time frames. I mean, 2 years from now, you and I will be living with problems that don't have names yet. I mean, you remember the Chinese spy balloon? For 1 week in 2023, that balloon was America. Every channel, every hour. When's the last time you heard about it? Half of what's on your screen tonight won't matter in 18 months. The hard part is just knowing which half. And the news is the worst source of information for that job. Prediction number 4. America gets skinnier and the food business starts missing earnings calls because of it. You see, the weight loss drugs, these GLP-1s, these ran up to $1,000 a month as injections. They all just became easily consumable pills. Novo's version got approved in December and racked up over 600,000 prescriptions in its first few months. Eli Lilly's pill got approved this spring at $149 a month, as low as $25 with insurance. The FDA approved Lilly's pill on April 1st. No joke, literally. And starting in July, Medicare Part D can cover it for about $50 a month, meaning the biggest adopters now won't be Hollywood. It'll be the retiree with a Medicare card. Odds are somebody at your own dinner table. Maybe all of you. Now follow this. Appetite. It's the oldest input in the entire economy, older than money itself. Nobody in history has ever suppressed it at scale. And the price of doing it just dropped from a car payment to a gym membership. If tens of millions of Americans eat meaningfully less food, snack companies, fast food, alcohol, they all shrink fast. They miss earnings, and Wall Street starts blaming GLP-1s on their losses. Actually, that already started. Almost 3 dozen companies outside of healthcare brought these drugs up on earnings calls early this year, up from 14 last year, 5 the year before. And one of America's biggest food distributors just told Wall Street its customers are shifting to protein and fresh food while restaurants are shrinking portions. The industry isn't beating this trend. It's surrendering to it. And this hits restaurants and grocery stores, and they happen to be the anchor tenants of American retail real estate. I mean, if you follow that pill far enough, and these GLP-1s reprice strip malls. So this is how these weight loss drugs can turn the entire economy upside down. You know, obesity drives about $173 billion a year in American medical costs. The blood pressure pills, the heart attacks, the bad knees, the mobility scooters. If those numbers start shrinking, healthcare doesn't disappear, it moves away from the blood pressure pills and the knee replacements toward the drugs themselves and the care of a country that's now living longer. I mean, we're only looking at the next 2 years here, but that ripple runs for decades. And when the country starts living longer, that ripples through the economy in an entirely different way, on countless different levels. Prediction number 5, the socialists keep winning. And your home equity, it ends up on the list of who pays for it. You see, if groceries and rent stay unaffordable, young voters keep reaching for whoever promises that relief. And that's not their ideology. That's just what a person does when funds are tight. The betting markets they already smell it. They have one party above 85% to take the House this November, behind a wave of candidates writing one word: affordability. And Tuesday night, this stopped being theoretical. A Democratic socialist named Angie Nixon just won Florida's Democratic Senate primary in Trump's home state. outspent 16-1. That's the first time in history a DSA member has won a major party nomination for statewide office. And here's why they may win for longer than we're all comfortable with. The only counter-argument on TV right now is a history lecture. Venezuela, the Soviet Union, Mao's China. Socialism has failed every country that's tried it. Very true, but a useless point at the moment. Because a 27-year-old paying $2,400 for a one-bedroom does not care what happened in 1962. The history lesson is just that, it's history. His pain is today. The messenger makes it even worse. That lecture is being delivered by the generation they trust the least. At the lowest point of respect for elders I can remember in my lifetime, we've got the wrong message and the wrong messenger. Not a great combination right now. And here's the thing, it doesn't matter if socialism eventually fails. The free stuff promised, it arrives on day one. The bill arrives way down the road. So it only needs 18 to 24 months of runway before the math starts showing up, likely not in time for the 2028 general election. So how does this land on your doorstep? Well, we've got aggressive wealth taxes, we've got unrealized gain taxes, we've got public ownership of the largest corporations and essential industries, publicly owned housing, and universal rent control. Generally speaking, we're talking seizure of private property. This is not conspiracy, it's not a reach. Those are direct quotes from the Democratic Socialists of America's platform, posted in public. Now, nowhere in there does it say, we're coming for your house. It doesn't have to. When the published direction is public ownership and controlled housing, your equity, it's standing on that road. It's not a quote. That's the goal. And yes, a primary win isn't a general election win. The betting markets still have Florida red in November. But the prediction was never that socialism wins the country next year. It's that it keeps winning the fight over what one of our two parties becomes. That was the one prediction Mike shared that scared me. Let's hope the younger generations are smarter than this and don't fall for the free stuff pitch from younger representatives with Instagram looks. But will all five land? Because they're all feasible. Which one of the five do you think is most certain to come true? Is it higher rates for longer? Higher prices forever? AI changes life as we know it? America gets skinnier and lives longer? And or the socialists take over? Let me know below in the comments. Is it one, two, all of them, none of them? You let me know. But here's what I do know is coming true, because the Fed just picked its winner for the next couple of years. And it was not you or your home. And that's why I picked this video out here for you to watch next. You see, when you deposit your money into a bank, it becomes their profit center. And they may give you 10% of that profit, but you can get on the right side of that trade to get the 90% for yourself. And I'll show you how and where here. Run your house like a business. Defend it like your home. God loves you, and so do I. Take care.